Ever wondered how the stock market works? Well, you've come to the right place. Today, we're going to unravel the complexities of the stock market, making it as simple as ABC for you to understand. Imagine the stock market as a bustling marketplace, not unlike your local grocery store. But instead of buying apples or oranges, you're buying and selling shares of companies. Intriguing, isn't it? Now, what exactly is a share? It's a piece of ownership in a company. When you buy a share, you essentially become a part owner of that company, no matter how small that part may be. This marketplace of shares, known as the stock market, is where buyers and sellers from around the globe come together to trade these pieces of ownership. Ready to demystify the stock market? Stick around and you'll be a stock market whiz in no time. Why should you consider investing in the stock market? Let's dive right into it. The stock market offers a unique opportunity to grow your wealth over time. One of the key benefits is the potential for profit. As companies grow and succeed, so do their stocks. This means if you own a piece of that company through stocks, your wealth grows too. But it doesn't stop there. Ever heard of compound interest? It's like a snowball effect for your money. As you reinvest your profits, they generate their own profits, which then get reinvested, and so on. Over time, this can lead to significant wealth accumulation. Lastly, investing in stocks allows you to own a piece of a company. This can be an empowering feeling, knowing that you're part of something bigger, something that can shape the world. Investing in stocks can be a powerful tool for building wealth, if done wisely. And that's why you should consider the stock market for your investment journey. So, what exactly are stocks, you may ask? Well, in the simplest terms, stocks are shares in the ownership of a company. When you buy a stock, you're actually buying a piece of that company. This makes you a shareholder, and as a shareholder, you have a claim on part of the company's assets and earnings. Now let's delve a little more into how this works. Companies issue stocks to raise money. They do this through a process known as an initial public offering, or IPO. In an IPO, a private company decides to go public, opening up its ownership to anyone who wants to buy a piece of it. Once the company goes public, its stocks are listed on a stock exchange and can be bought and sold by the general public. There are two main types of stocks that you need to know about: common stocks and preferred stocks. Common stocks are the most common type of stock that investors buy. When you own a common stock, you get the right to vote at shareholders' meetings, and you may receive dividends. Dividends are a portion of the company's profits that are distributed to shareholders. However, it's important to note that not all companies pay dividends, especially those that are still growing. Preferred stocks, on the other hand, don't usually come with voting rights. But here's the catch. Preferred stockholders have a higher claim on the company's assets and earnings. This means if the company pays dividends, preferred stockholders get paid first before common stockholders. And if the company goes bankrupt, preferred stockholders are also first in line to get any remaining assets. But remember, whether it's common or preferred stocks, there's always a level of risk involved. The value of stocks can go up or down, and there's no guarantee you'll make money. In essence, when you buy a stock, you're buying a piece of a company. You're investing in their success and betting that they'll grow and make money. But like all investments, it's important to do your research and understand what you're getting into. You're probably wondering, how do you buy stocks? Well, the process isn't as daunting as it might seem. Let me guide you through it. First, you need to decide where you're going to buy the stocks. This is where brokerage firms come in. Brokerage firms are companies that are licensed to trade stocks through the exchange. They act as a middleman between you and the stock market. You can choose from traditional brokerage firms, where you'll have a dedicated broker who handles your account, or discount brokerage firms, which are typically online and allow you to manage everything yourself. Nowadays, many people prefer online platforms as they offer convenience and lower fees. These platforms can range from mobile apps to full-fledged websites, and they provide the tools you need to buy and sell stocks. Once you've chosen your platform, the next step is to open a brokerage account. This is similar to opening a bank account, but with a brokerage firm. You'll need to provide some basic information, such as your name, address, and social security number. You'll also need to decide what type of account you want to open. The two main types are individual accounts and joint accounts. Once your account is open, you'll need to fund it. This usually involves transferring money from your bank account to your brokerage account. The amount you need to start with can vary widely, from as little as $25 to several thousand, depending on the brokerage firm and the type of account. After funding your account, you're finally ready to buy stocks. You'll do this by placing an order. You'll need to know the ticker symbol of the stock you want to buy, which is a unique series of letters representing that company on the stock exchange. You'll also need to decide how many shares you want to buy and at what price. And there you have it. A quick rundown of how to buy stocks. Remember, investing in the stock market is a journey, not a race. It takes time and patience to learn the ropes and make informed decisions. And voila, you're set to start making your first investment. Now that you know how to buy stocks, how do you choose which ones to invest in? Well, there are several basic investment strategies that you can adopt. Let's take a look at a few. Firstly, there's the strategy of investing for long-term growth. This is where you buy stocks in companies that you believe have potential for significant growth over the long term. It's like planting a seed and patiently waiting for it to grow into a tree. The key here is patience and a keen eye for spotting companies that have a bright future. Then, there's the strategy of investing in blue-chip companies. These are large, well-established companies that have a history of stable earnings. They're like the sturdy ships in the sea of the stock market, less likely to capsize in turbulent waters. Blue-chip companies often pay dividends, which can provide a steady income stream in addition to any potential capital gains. Another strategy is diversifying your portfolio. This means spreading your investments across a variety of stocks in different sectors. It's like not putting all your eggs in one basket. Diversification can help reduce risk because even if one stock performs poorly, others in your portfolio might do well. No matter which strategy you choose, it's important to do your research and understand the company before investing. Look at the company's financial health, its competitive position, and the industry trends. Investing should never be a shot in the dark. It should be a calculated decision based on thorough analysis. You can use online tools and financial news sources to gather information. You can also consider hiring a financial advisor to help guide your investment decisions. At the end of the day, your investment strategy should reflect your financial goals, risk tolerance, and investment horizon. You need to be comfortable with the level of risk you're taking and understand that investing in the stock market involves ups and downs. Remember, investing isn't gambling. It's about making informed decisions. So, equip yourself with knowledge, make a plan, stick to it, and watch your investment grow over time. Investing in the stock market isn't without its risks. Let's face it, folks, the stock market isn't a predictable beast. It swings, it sways, it sometimes even staggers. This volatility is part of the game, and it's what makes investing both exciting and nerve-wracking. Yes, the market can be as volatile as a stormy sea. One day your stocks might be riding high on the waves, and the next, they could be deep down in the abyss. You see, when you buy a stock, you're buying a piece of a company. If that company does well, your stock might increase in value. But if the company struggles, your stock's value could plummet. And this is where the risk lies. There's always the potential for loss. Just like a gambler at a casino, you might roll the dice and come up short. This is why it's so important to invest money you can afford to lose. The stock market isn't a magical money tree, and it certainly isn't a get-rich-quick scheme. It's a long-term commitment that requires patience, research, and a stomach for risk. You might be wondering why anyone would want to invest in something so risky. Well, here's the thing. The potential for reward is also significant. Yes, you could lose money, but you could also make money, sometimes a lot of it. Those who have reaped the benefits of their investments know that the rewards can be worth the risks. The key is balance. A diversified portfolio, that's a mix of different types of investments, can help to balance out the risks and rewards. Some investments might do well when others do poorly, helping to even out the bumps in the road. So let's not forget, investing is not just about making money. It's about growing your wealth over time, about securing your financial future. It's a journey, and like any journey, it comes with its share of risks and rewards. But remember, with greater risk often comes greater reward.